In 1988, Warren Buffett, through his company Berkshire Hathaway, invested almost $1 billion into the Coca-Cola Company, which represented almost 6.3% ownership in the entire company. Since then, the stock has risen at a compounded annual growth rate of 10%, which is really impressive for a 30-year period. But not only that, Berkshire Hathaway, Warren Buffett's company, now receive a 62% dividend yield on the price that they initially paid for Coca-Cola stock. So not only have they made a lot of money in terms of the capital appreciation, the stock price going up, but the cash flows that they receive, the dividends that they receive from Coca-Cola are now astonishing. And this has essentially made Coca-Cola one of Warren Buffett's and Berkshire Hathaway's most successful investments of all time. So in today's video, I'm going to start by talking about what were the characteristics, what were the principles that Warren Buffett applied to this stock that made it such a good investment and made him invest $1 billion of Berkshire Hathaway's money at the time in 1988. And then I'm going to talk about how you could have reached the exact same conclusions by following the 4-step process that I teach on this channel. And that 4-step process basically follows the 4 major principles that Warren Buffett has spoken about his entire life. So if you do enjoy this video, I would very much appreciate it if you could hit subscribe or leave a like or leave a comment, anything like that. I put a ton of effort into this video, but for now, let's get straight into this video. So if you've been following the channel for any period of time, you would know that there are 4 major principles or steps to investing that I always talk about when I'm investing. And the reason why I talk about those 4 principles is because those are the 4 principles that Warren Buffett has used over his lifetime and that he's detailed in various interviews and letters to the shareholders. And these are essentially the 4 pillars in which Warren Buffett built his investing empire. And that's what I like to teach on this channel, is what have successful investors in the past been able to do so that we can mimic those principles and be able to build our own successful portfolios. And those 4 principles are essentially circle of competence, economic moat, management, and intrinsic valuation, or margin of safety. Some people like to call that last one. And really, these 4 principles are quite simple in themselves, but they're the foundation of much more detailed stock analysis that you need to do into each of the others, and we'll discuss all of them in relation to Coca-Cola in this video. But essentially, circle of competence starts by investing in businesses that we're passionate about, and more importantly, in businesses that we understand, not going outside our area of understanding, our area of expertise, and investing in what we know. And that is the first major step to investment. And Warren Buffett needed to fulfill that step before he could go ahead and analyze the Coca-Cola Company as an investment. And the Coca-Cola Company is certainly a business that was well within Warren Buffett's circle of competence. Warren Buffett has always had a close relationship with the Coca-Cola Company and its products. All the way back in the late 1930s, when Warren Buffett was just 9 years old, he would go around to vending machines and collect the discarded bottle caps from various drinks. He would then collect all of these and he would add them up and work out what percentage were Coca-Cola, what percentage was Pepsi, what are the different percentages, and what were people's favorites at the time. And even back in the 1940s and 1930s, Coca-Cola was a standout favorite. And this is where Warren Buffett started to develop an understanding for the Coca-Cola Company. And beyond that, Warren Buffett is also an avid Coca-Cola drinker. It's not unknown that Warren Buffett loves to drink Coca-Cola and to this day continues to drink it every single day. So that is another way that it shows that Warren Buffett had a passion for Coca-Cola and that he had a close relationship with it for many years, even 50 years before he even put a single dollar of his own money into the company. So Warren Buffett clearly had a passion and a close relationship with the Coca-Cola Company, but that is certainly not enough. You then need to make sure that you understand the business and that it's in an area that you're an expert in. And this also was the case for Coca-Cola Company and Warren Buffett at the time. Warren Buffett has spoken about in various interviews how one of his areas of expertise is understanding consumer behavior and understanding consumer products and how people behave and how people buy them. So check out this clip from CNBC where Warren Buffett talks about how an area of his expertise is in understanding consumer behavior.
I think I understand consumer behavior perhaps better than I do the tech business. Wouldn't take much to beat it. And
so in the late 1980s, when Warren Buffett was considering whether or not to invest in the Coca-Cola Company, he certainly felt as though it was a business within his circle of competence because of his past history with the company and his area of expertise in investing in businesses with consumer products. But then the next step is to make sure that the business has an economic moat, a wide economic moat. And essentially what an economic moat is some kind of long-term competitive advantage that's unique to the business and giving it an advantage over other companies. Warren Buffett often talks about commodity businesses where people are selling the exact same products as their competitors and there's no distinct advantage. These businesses have a lot of trouble sustaining themselves over the long term because essentially if two companies are offering the exact same service or product, the only way they can outmatch each other is on price, and that is just going to be a race to the bottom of which one is going to be willing to charge the least and offer the best price to the customer. So companies certainly need to have a distinct advantage. And the Coca-Cola doesn't have one advantage, it doesn't have two advantages, it doesn't even have three distinct advantages. It has 4 advantages over other companies in its industry. The first competitive advantage that Coca-Cola had was brand loyalty. And this may seem strange if you had never heard of Coca-Cola, but you just looked at their product, because their product is essentially sugar water. It's really no different in many ways to all of the other options, and even it's very similar to all of the other cola alternative products. So in many ways, just looking at the product, it seems as though it's a commodity. It's one of those businesses. But Coca-Cola was not a commodity because of the way they built a brand around their product. And they did this for many years. The company's been around since the 19th century. So even up until the point in the 1980s, the company had been around for almost 100 years, or maybe even over 100 years. And over that time, they had spent a lot of money marketing their product in terms of having partnerships with the Olympics even, which seems really strange today, considering that it's not very healthy, but they had partnerships with the Olympics. Their advertising was renowned for being very good. And as a result, they built a cult-like following around the product. And people sort of had this trustworthy and respected opinion of the company. And that was sort of built over many, many years. And up until the 1980s, Warren Buffett looked at the company and saw that this loyalty brand, while it started off really small, and in the beginning when any product launches, it's not likely that a company is going to immediately have a strong brand, but over time it had been building up, and at the time in the 1980s, the Coca-Cola brand was very, very strong, and it was clearly the strongest that it had ever been in the past. Coca-Cola beverages were consistently priced higher than other cola alternatives, and even though they were priced higher, people still bought them in higher volume than any other soft drink. And that tells you something about the competitive advantage. And what Warren Buffett has said about this in the past is that if a company is able to consistently raise their prices, yet the same customers come back and buy the product regardless of the price, it's a clear indication of a competitive advantage, of something unique to the business. Think about it. If a customer comes into the store and sees that Coca-Cola is 10% more expensive and their competing product is significantly cheaper, but they're still picking up the Coca-Cola can, it's because it's something unique in the Coca-Cola brand or the Coca-Cola product that they want. And that is a clear indication of the brand loyalty that the company had developed. And then moving on from brand loyalty, the second advantage they had was that it was a product that had repeat customers. Now, back in the 80s, before the internet, this was the closest you could get to recurring revenue. Like these days, you have something like Adobe that has an online subscription that's recurring revenue. But back in the 80s, this wasn't very common. And the closest that you could get was a product that people just consistently bought. A product that people bought every single day. It became a part of their routine, psychologically and physically, as we'll talk about in just a second. But having repeat customers is a huge advantage for a business because it means that your revenues and cash flows are going to be very stable over time. It's not as if you would sell a whole lot in one year and then it would drop off substantially in the next year. For the most part, Coca-Cola customers were consistently buying products. It became a routine, kind of like how a lot of people would pick up a coffee from Starbucks on the way to work in the mornings. They just walk down the block, there's the Starbucks, they buy it. It becomes a part of their routine. And this again is a huge advantage that Coca-Cola had over some of the other companies in its industry. And I just briefly mentioned that it becomes a psychological habit as well as a physical habit. And the reason for the physical habit aspect is because the product itself contains two addictive substances, caffeine and sugar. Caffeine in particular is known to be physically addictive, which means that not only is it psychologically part of a routine, but it becomes a dependence that people rely on a day-to-day basis. Now, for some people, this might mean that it's not a company you want to invest in because it goes against your ethics or your morale or something like that. But for other people, like myself, I would say that caffeine's biggest downside, and addiction to caffeine's the biggest downside to it, is that it costs you money. There's no real evidence that there's significant health effects of drinking coffee. Maybe Coca-Cola is a different story because it has other addictive substances in it, such as sugar. But caffeine itself really doesn't have any negative long-term health impacts, and it in many cases has been seen to have positive long-term impacts for regularly drinking caffeine. So the fact that it was an addictive substance is another advantage, because not only does it have to psychologically become a routine that people go and buy the Coca-Cola, but it was physically becoming part of their routine. Something that physiologically was demanded by consumers. And that's another huge advantage. And then the final advantage, which is probably one of the most important advantages that a company can have, is economies of scale. And essentially what economies of scale mean is that as the company gets larger, their costs don't rise as fast. So there's two types of costs that a business can incur. There's fixed costs and then there's variable costs. And variable costs go up as the business grows as well. As the business sells more products, they have higher variable costs. Now, Coca-Cola had very little variable costs, and most of their costs were fixed, which meant if they had to sell an extra 1 million units, their costs weren't going up at the same rate, if that makes sense. If you had a factory and it's moving 1 million units every month, and then you start selling 2 million units every month, you might not need to build a new factory yet. The factory cost might be the exact same, and the variable costs are very small. And that's something that Coca-Cola was able to take advantage of. And the best way that we can sort of show this is by looking at the growth of their sales and free cash flow over the 10-year period ending in 1988. So when Warren Buffett would have been looking at this company, I pulled all of the annual reports, went through them, and put all the data into a spreadsheet. And essentially you can see that from the 10 years up until 1988, Coca-Cola's sales, so their revenue from selling units, grew by 6.6%. But in the same period, their cash flow, their free cash that they were generating, grew by almost 14%. So that's a substantial difference, and the reason why there is that difference is because as they sell more units, their costs don't rise as fast, which means they have a lot more free cash available. And this is the final and probably most significant, or one of the most significant advantages that Coca-Cola had over other companies in its industry. The third component of analysis that Warren Buffett does is he looks at management, and he needs to make sure that management is trustworthy and also good at their job. So those are the two major requirements. And it's difficult to say what Warren Buffett saw in management in terms of trustworthiness, or whether he knew the management at the time, just because the data is so old now and it's very hard to find data in the 1980s for this stuff. But in terms of their skill at investing within the business, we can certainly look at that. And I've compiled all of the data in terms of their returns and how much capital they invested, so that we could come up and have a look at their 10-year return on invested capital, which essentially tells us how much do they generate in free cash compared to what they're investing within the business. What kind of return are the managers getting on their investments within the business? And this is super important for long-term investors. We need management to be good at their job. So let's take a look at the return on invested capital and see what it looked like for Coca-Cola in the 1980s. So as you can see, the return on invested capital for Coca-Cola throughout the 1980s was consistently above 10%. It was growing over time. And in 1988, the year in which Warren Buffett started investing in the company, its return on invested capital exceeded 20%, which is extremely impressive. Another important measure of management skill is to see how effective they are at keeping debt to a low level so that there's little risk to the shareholders. And essentially at the time in 1988, they had a long-term debt to equity ratio of 0.22, which is really low. It means they have a lot more equity invested in the business than debt. And it means they're not taking on debt to fund their investments. They had a little bit of debt, but for the most part, they were using their free cash to shove back into the business and generate compounded cash flows over the long term. So in those factors, Warren Buffett was able to see that the company did have a management team that was very good at their job and was trustworthy. And that was the third component of his analysis. And really, those first three parts are essentially about answering the question, is the business great? Is the business one that I love? Is it a business that I understand? Is it a business with competitive advantages? And is it a business run by trustworthy and good people? And then the final component, the final principle, is intrinsic valuation. And this has nothing to do with whether it's a great company or not, but all to do with how much should we pay, depending on what we're going to get out of this company over the long term. Now, of course, I don't know what Warren Buffett did, what maths he did in his head or on paper in regards to the Coca-Cola Company, but using what he's spoken about and how he values companies, I came up with a couple of different models that came up and showed that Coca-Cola was a buy based on their past record and based on a few simple assumptions. So let's jump over to my computer and have a look at my spreadsheet, which I put together, where I show why Coca-Cola at that price in 1988 was probably a good investment, and it's probably why Warren Buffett decided to start investing. Now, there are a lot of numbers on this screen, but I'm going to go through and explain some of them. So in terms of the growth rates, I chose growth rates between 6 and 14% because 14% at the top end was their long-term free cash flow growth rate. But we also had sales, equity, and earnings per share growing at somewhere between 6 and 7%. So I wanted to include a range of growth rates that captured both of those extremes. The year zero cash flow is my estimation of Coca-Cola's cash flow for owners in 1988. So this is a figure, cash flow for owners, that I talk about on the channel sometimes, and it essentially is an estimation of how much cash was returned to shareholders in the previous year, in 1988. If you're interested in learning more about cash flow for owners, then let me know. But essentially the formula I use is operating cash flow, and then I subtract my estimation of maintenance capital expenditure. And for the Coca-Cola Company in 1988, I estimated this to be just below $1 billion. So that's $975 million. Further down on the left, you can see I've got a box for risk-free rate and then required rate of return. The risk-free rate is used to calculate intrinsic value and is the 10-year treasury yield. So at the time in 1988, this was 6%, so I've entered that there. And then the required rate of return is the return that we're personally targeting. So I've entered in 15% in this case. And then we get a range at which intrinsic value likely sits and a range at which it would be smart to start buying this company based on what return we're trying to make, which is 15% in this circumstance. So you can see that the intrinsic value based on the risk-free rate of 6% gave us an intrinsic value of somewhere between just under $19 billion for the whole company and $34 billion for the whole company. That's that table there, 19 billion, 22 billion, 25 billion, 29 billion, and then just under 34 billion. And then one column over, you can see it says buy price. And this is still in terms of the whole company. So we're doing a whole company view of this, but this is based on our required rate of return. And this gives us a buy range of somewhere between 10 billion, 11 billion, 13 billion, just under 15 billion, and then 17 billion. So if we were to start buying in that range, then it would be likely that we would see a return that's approximately 15%, whether that's a little bit below or a little bit above. In 1988, the market capitalization, the price for the entire business of Coca-Cola at the time, was about $15 billion. So that sits right in between that range of buy price that my calculator spit out. My calculator spat out between 10 and 17, and in 1988, the stock was hovering at about $15 billion when Buffett started to make some investments. So it's likely that Buffett came to a similar conclusion to what I did just then, because he started buying in the range at which I would have started buying if I had done this calculation back in 1988, if I wasn't negative 10 years old at the time. But anyway, guys, I hope this video served as a good example of how Warren Buffett himself goes through quite a simple investment process, but just dives deep into those principles. You don't need to get fancy with all of these different technical analysis things and all of these different things that people throw in your faces these days. The principles are really simple. Businesses you understand, with competitive advantages, with great management teams in terms of their trustworthiness and their skill at investing, and do a simple intrinsic valuation to estimate how much cash we're going to get so that we can estimate how much to pay. The principles are quite simple. What's difficult is really the application of them and knowing what sort of details to look at in order to fairly assess each of these sections. So if you're interested in learning more about this 4-step process that I just went through in this video and that I talk about all the time on my channel, of course, if you're new around here, then hit subscribe and check out some of my other videos. But if you're ready to dive deeper into the analysis process, then I actually put together a free 20-minute training video on my website, which you can get access to via the first link in the description below. And I go through all of those 4 pillars, as well as talking about some of the basic mistakes that people make when they get started. But other than that, again, I put a ton of effort into this video. So if you did enjoy it, I would very much appreciate it if you could interact with the video in some way. Subscribe, like, leave a comment, share it with a friend even is probably the best thing you could do. But I hope you guys have a great day, and I'll see you in the next video.